Hello everyone, welcome to our in-depth look at the numbers shaping today's financial landscape. Let's talk about gold, a cornerstone of the financial world, and a symbol of stability and value for centuries. Gold has always been more than just a precious metal. It's a barometer for economic confidence and a safe haven in times of uncertainty. Today is Monday, February 16, 2026. And gold prices are making headlines around the globe. Investors and analysts alike are watching closely as the numbers shift. Spot gold has dipped by 0.6% to $5,015.40 an ounce, while gold futures are down 0.2% to $5,035.25. These figures may seem small, but even minor movements in gold can have ripple effects across the financial sector. These aren't dramatic drops, but they signal a market in wait-and-see mode. Investors are pausing, assessing the landscape, and considering their next moves carefully. Gold, like the tide, moves in and out. What matters is understanding why. The ebb and flow of prices reflect not just supply and demand, but also global events, policy changes, and investor sentiment. This small dip is a reminder to look at the bigger picture, not to panic. Short-term fluctuations are normal, and often present opportunities for those who stay informed and patient. Other precious metals are also down, silver by 0.9%, platinum by 1%. These metals, like gold, are influenced by similar market forces, and their movements often echo each other. When all metals move together, it's a sign of broader market sentiment, not just gold-specific news. It suggests that investors are reacting to larger economic signals, such as inflation data, interest rate changes, or geopolitical developments. This is a market-wide trend, investors reacting to global uncertainty. Whether it's political unrest, economic reports, or shifts in central bank policy, these factors can drive synchronized moves across precious metals. The takeaway? The financial world is always in motion. Markets respond to news in real time, and prices can change in the blink of an eye. Gold above $5,000 an ounce is still historically strong. This level reflects years of growth and resilience, even in the face of volatility. Today's dip reflects a market waiting for the next big event. Investors are holding their breath, watching for signals that could set the next trend in motion. This isn't a time for rash decisions. It's a time to get informed. Staying updated and understanding the context behind the numbers is key to making smart choices. Use this moment to become a smarter, more powerful manager of your financial future. Take the time to review your portfolio, consult with experts, and set clear goals. We're here to help you do just that. Let's dive in together, explore the trends, and make sense of what's happening in the world of gold and beyond. Why are gold price moves so muted today? Holidays. Major markets, China, South Korea, and the US, are closed. With these economic giants offline, global trading volume drops sharply. Fewer trades mean less price action, a phenomenon called thin trading. It's a rare pause, letting us see the market's underlying pressures more clearly. The global market is a 24-hour conversation, but today, the loudest voices are silent. Prices drift gently, waiting for everyone to return. This is a lesson. Even holidays on the other side of the world can impact your investments. The gold story is global. Every player matters. Understanding these connections is key to financial intelligence. The last 2 weeks have been a wild ride for gold. Prices have moved up and down with remarkable speed, leaving many investors both excited and anxious. If you've been watching the markets, you've probably noticed just how quickly sentiment can shift. We've seen sharp swings, classic volatility. These rapid changes are driven by a mix of economic data, global events, and shifting investor expectations. For many, it's a reminder that gold, while often seen as a safe haven, is not immune to dramatic price moves. Last week, prices rose as investors bought the dip, and the US dollar weakened, making gold more attractive globally. When the dollar falls, Gold becomes cheaper for buyers using other currencies, which can boost demand and push prices higher. Geopolitical tensions, like those between the US and Iran, also push demand for gold as a safe haven. In times of uncertainty, investors often flock to gold, seeking protection from potential market shocks or instability. But despite these gains, gold and silver remain below their late January highs. The rally has been impressive, but it hasn't been enough to break through previous resistance levels, reminding us that the market still faces headwinds. The market is torn between fear and central bank policy. On one hand, worries about inflation and global conflict drive investors toward gold. On the other, central banks' decisions on interest rates and monetary policy can quickly change the outlook. Fear of conflict drives prices up. Worries about interest rates pull them down. When rates rise, gold can lose some appeal, since it doesn't pay interest or dividends. This is volatility in action, a test of investor discipline. It's easy to get caught up in the excitement or fear, but reacting emotionally can lead to costly mistakes. Don't chase highs or panic at lows. Instead, take a step back and remember your long-term goals. Successful investors know that patience and perspective are key. Have a long-term plan and stick to it. Review your strategy regularly, but avoid making impulsive decisions based on short-term market moves. Know why you own gold and how much you need. Gold can be a valuable part of a diversified portfolio, but it's important to understand its role and not overcommit. Volatility is a test. Pass it with discipline. Stay focused, stay informed, and remember, the best investors are those who keep their cool when markets get turbulent. What's pulling gold down from its highs? The Federal Reserve. The nomination of Kevin Warsh as possible Fed chair shook the market. Warsh is seen as less dovish, meaning he may favor higher interest rates. Higher rates make interest-bearing assets more attractive than gold, which pays no yield. Even the hint of a leadership change can shift market strategy. The Fed's decisions ripple through your assets. Pay attention. Understanding Fed policy is essential for protecting your wealth. Beyond the Fed, tariffs and inflation are shaping gold's future. Tariffs can raise consumer prices, fueling inflation. Gold is a classic hedge against inflation. Its value often rises as the dollar's purchasing power falls. Analysts expect tariffs' effects to show up soon, boosting demand for gold. If the Fed can't control inflation, faith in the dollar drops and gold shines. Look past daily swings. Focus on long-term trends. Are prices rising in your life? That's why people turn to gold. It's about preserving wealth, not getting rich quick. Gold is your shield against economic erosion. This week is crucial for gold. On Wednesday, the Fed releases minutes from its January meeting. Investors will scour them for clues on interest rates. These minutes reveal the Fed's real concerns and internal debates. Later, we get the PCE price index, the Fed's preferred inflation gauge. This data will shape expectations for rates and gold's direction. By week's end, we'll know more about the forces driving gold. Don't act yet. Wait for the facts. Smart decisions follow good information. Gold's price is more than a number. It's a global mood ring. Rising prices reflect fear and uncertainty. Falling prices signal confidence. Gold is a barometer of global sentiment. Watching gold helps you understand the world's mood. It's not about timing the market, but reading the signs. When gold climbs, check your own financial safety net. Gold is a warning light for turbulence ahead. Think of it as a global sentiment indicator. Learn to read gold's story, and you'll be a smarter investor. So, what does all this mean for you? When it comes to your financial future, the decisions you make today can have a lasting impact on your wealth and peace of mind. Understanding how to position yourself for both growth and protection is key. Gold's role is to help you stay rich, not get rich. It's a safeguard, a way to preserve what you've worked so hard to build, especially when markets get unpredictable or economies face uncertainty. Think of it as financial insurance, something you hope you never need to rely on, but you're grateful to have if things go sideways. Just like you wouldn't drive without car insurance, holding some gold can help protect your financial journey. With today's volatility, it's easy to get caught up in the headlines and make big, emotional moves. But reacting impulsively can often do more harm than good. If you decide to buy gold, consider doing it gradually. Dollar-cost averaging, buying a little at a time, can help smooth out the bumps and reduce the risk of buying at the wrong moment. Already own gold? Stay calm and remember why you bought it in the first place. It's there to provide stability, not quick profits. You bought it for long-term security, to act as a buffer against the unexpected. Let it do its job by holding steady through market ups and downs. Don't sell in a panic. Stick to your plan. Emotional decisions can undermine years of careful planning and discipline. Gold should be part of a broader financial strategy, not the whole plan. Diversification is your best defense against uncertainty. Most experts suggest keeping 5 to 10% of your portfolio in precious metals. This allocation provides a cushion without sacrificing growth potential in other areas. The goal is to have enough for a cushion, but not so much that it drags down your overall returns. Balance is key. Remember, gold is just one piece of your financial puzzle. Stocks, bonds, real estate, and other assets all play important roles. Make sure all the pieces fit together to create a secure, resilient portfolio that supports your long-term goals and gives you confidence for the future. We've explored gold's world. Now, what's your next move? Don't rush to buy or sell. First, get your financial house in order. Emergency fund, no high-interest debt, retirement savings. Gold is protection, not the foundation. Treat it as a long-term security, not a trading play. If you add gold, do it steadily and thoughtfully. Keep learning. The more you know, the less you fear. You have the power to control your financial destiny. Education is your greatest asset. If this helped you, subscribe for more practical finance lessons. You decide.